Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, November 15th, 2023. It's 11:34 a.m. Eastern Time as I'm starting the video, and I think I've got a lot that I want to share in this one. I think it'll be worthwhile, so let me walk you through how I'm going to do it. There were, as always, there's some good questions put on the site, on the board, under the comments section, so I'm going to start there. Just highlighting a few of the recent questions and my replies. That's going to segue into a brief update or overview on market breadth. We're going to look at also the what I call I think the market calls the king of AI, and that's NVDA, and really how that's not just put a lot of a bid under the market this year, a lot of hype on that. And, of course, AI is here to stay, but it's, again, not anything new. It just kind of became suddenly super popular with ChatGPT. And again, I'll get to that without being too wordy. Just a brief update on the stock itself, because they're scheduled to report. And also I want to, again, which I've done in the past, but kind of reiterate the impact that NVIDIA had on even the bigger Mag 7, the big stocks, Apple, Alphabet, and Microsoft, and those that have really carried the market due to their higher weighting. So I'll get to that in a second, explain that. Then I will, again, so we're going to hit on market breadth. Towards the end of the video, I'm going to briefly talk on fundamentals, continuing to watch things such as jobless claims, unemployment reports, and some developments in the bond market. And then, most importantly, I'll kind of recap the video at the end. I'm kind of structured this out to really kind of nail down timing on if we're going to have a big turn here in the market, when that turn is going to come, what to look for, what are the catalysts that can cause that. And we have a very short window. So, I think one of the things I do different, there's a million and one market pundits out there, and everyone's got their own opinion, and they make these calls where the market or a stock or a sector is going to go. But what I work really hard to do, and I think I do it as good or better than anyone I've ever seen, is timing these things. And you don't always get it right. By the way, I see the snide comments on there every now and then. There's in early or just wrong on something, and all of a sudden it's like the end of the world for some folks. I've had a good year. We've caught almost all the rips and dips on the way down, the big zigs and zags. When you look at the market, the NASDAQ 100, there's a period of pain right here where that was and I'll get to that in a second, that was the NVIDIA gap right there. And it kind of set the tone, blew through some divergences and other technicals, and that was probably the for me on the indexes, the worst trading part of the year. This one here, remember, covered shorts, made it very clear, not just saying, hey, we might bounce, but going so far as to say I think it's time to cover shorts and even go long. But admittedly, and I gave you my mea culpa just shortly afterwards, stating, even before the bulk of the rip, just stating that I was, as I said before, super bullish on bonds, calling that top in yields and the bottom in bonds almost with impunity right at the bottom, and then stating how it just didn't mesh. And I would point out these objective short entries like the back test of the downtrend line, all that just got burned through. And again, kind of acknowledging at that point that it didn't mesh. As long as rates were falling, it was very hard to envision a pullback. But with that being said, at this point, I strongly maintain that I think the RR, the risk-reward ratio, in the very near term at minimum, is still skewed to the downside. So the way I work, I'll take shots all day long. Some are going to pan out, some won't. But just because we break out and don't reverse at a certain level, I think, or the turn doesn't come where I think it's going to come, doesn't mean then all of a sudden I'm just going to flip and go bullish. There are quite a few bullish developments in both bonds and stocks that I've highlighted recently. And so again, being short right now is a highly contrarian call. But if you recall, I've talked about this before. I have a map in my head. I work off of that map. It's constantly changing. think of it like I've used analogies. You can talk about, maybe a coach going into a football game. He knows the team he's playing. He knows the players. He knows who he needs to pair up against his, what defense he needs to run against their offense, et cetera, et cetera. But guess what? That plan can and often does change, especially when they go into the locker room at halftime. If the team's behind, they're going to try to, shut down the running game or put pressure on the pass or whatever it is. And that is meaning an adaptive plan. So right now, I still have the bigger picture plan, how I think this thing's going to play out. There's a lot of evidence supporting that. Near term, we've made some, like I said, very bullish developments, particularly the breakout in not just the NASDAQ, but the broad-based index of the primary downtrend line. And again, what's going on in Treasury bonds. So it is certainly not, as I've been saying all along, even back here when we were short coming down into those lows, certainly not an all-in moment until and unless the 200 days went on the NASDAQ 100 and all the big tech stocks in those purple levels I gave you on the Mag 7. So I guess the takeaway is, point out these short pot shots and all that, but it's, it's not been, if you've, as I have, milked, not all, but the bulk of these swings. We've swing traded this down from sell signals as early as right here, pointing back multiple entries. Correct me if I'm wrong. You can go back on the site. I believe we're along, and again, maybe not from the very bottom to the very top, but the bulk of both of these counter trend rallies so far, including this one, myself personally, admittedly got out too long, but I did clearly state when I stated reversing, closing all shorts and going long recently at the 200s or just before, that there was certainly the potential for a much stronger bounce if those support levels held, which they did, and, beating the 200 days, the purple lines on all the Mag 7 stocks, and the divergences played out, which they certainly have. So, again, I move on to the next one. I didn't catch it all. In hindsight, I probably should have just kept trailing stops up, but I don't regret it. I would have taken that shot over again, a short at the test of the downtrend line there. But again, that doesn't matter to me. It's where we're going from today, and that's what I'm about to cover. So let's start out with the Q&A. Let's go right into the site. Just in the last couple of days, these are last few of the posts. If there's any new comments, I caught up to most of them that I could that were direct questions. Somebody brought up about sweet breadth thrust. I'm very familiar with that, and how it marks bull markets begin with that. And it was we had one yesterday. I haven't confirmed it. I'll just take the word on that. Just keep in mind that I don't know if we had one back, but it wouldn't be if we had one yesterday. It wouldn't mark the beginning of a bull market because the current trend. Talking the intermediate term trend, when you look at the charts, it's clear that October 12th of 22, so over a year ago, marked the bottom. And again, it's a bottom that I maintain is most likely a start of a bear market rally. But if we're in a new bull market, then that would be where it's measured from, because unless we take that out, that's the low. So either way, and this is kind of going to segue into what another question here. So somebody asked, okay, again, this was posted yesterday. I didn't see it until today. What was the AD, the advance versus decline ratio today? And yeah, I noticed everything was green across the board. When you have a day like yesterday, not always, but usually on a day like that with, indexes up, most indexes or all of them up 2% or more, you're going to have almost all the stocks in the S&P and the NASDAQ 100 up. So, but here's my reply. This is the most important thing. So I said, not sure what the AD ratio was yesterday, but it doesn't matter to me as one day does not make a trend. You've heard me say that many times. It's another kind of just something I've come up with over the years. What does make a trend is or are consistent technical developments that occur over weeks or months, such as the stark divergence and underperformance of one of my favorite breadth indicators, which is the NAAD, and that's the NASDAQ advancing versus declining issues line, so far in 2023. So here's the chart below. I'll show it to you, but I also updated it because I had this chart showing it against the NASDAQ composite. And what I wanted to point out is the divergence is even more stark in the NASDAQ 100. And again, it speaks to what not just I recognize this early on, and again, long, strong, and bullish the FANGs, expecting them to outperform from the beginning of the year. That outperformance has continued pretty much throughout the year, and it is distorted or given a false perception of how the market is done. Again, I'm going to loop back to this in 1 second. This is well, let me show you the NDX. They're going to look almost identical. And what I'm talking about here, this is the chart I've had up forever and a day. I've had this chart for over a decade. It's the NASDAQ Composite versus the NAAD. So the NASDAQ advanced versus declining issue line is down here. And as you can see on my notes, years back, I've learned it's best used as only a topping indicator, as positive divergences are not common at the bottom. So there was the end of the Great Recession, bear market, and you had the NAAD heading down, and so did the NASDAQ putting in that low there. So that was not positive divergence. They were mirroring each other. And again, I've seen it at most bottoms. So you don't have that. And so this isn't just looking at the market in bear goggles, just trying to look all tops only. I'm just saying this one indicator is used, and it's extremely accurate in identifying the tops, the big tops. You can see them all highlighted here. So let me pull up the same one, just comparing it to the NASDAQ 100. For those of you not familiar, NASDAQ Composites, all the stocks listed on the NASDAQ, and that has tons of them, small, mid, large caps. The NASDAQ 100 is just the largest 100 in the NASDAQ. Okay, and here's that chart. And again, this is kind of big picture stuff. These, you've heard me say it once, you've heard me say it a million times. Divergences are not buy or sell signals. They are conditions. Just like if it's cloudy outside, you see some gray clouds, dark clouds building. That's a condition that it's a good chance it's going to rain, but it doesn't have to rain where you're at, or the rain doesn't even have to fall from the sky. Sometimes clouds get gray, and it's the water just stays up in there, and then the clouds dissipate. So same kind of thing here. So, but however, more often than not, you see some pretty dark clouds. If you live where I live in Southwest Florida, lightning capital of the United States, we get boomers all the time. You feel that air temperature drop about a good 5-8 degrees in a matter of like a minute or so. You know what I'm talking about. If you live down here, it's about to rain. That rain's coming. And so that's where you look for the divergences. You look for those things to build, and then you hone down on you use other things. You use price, support and resistance levels on the indexes, on the market-leading stocks. You look for divergences on the momentum indicators. This is a breadth divergence. Remember, divergences can be used in many different ways. We're not looking at the PPI, the RSI, or any other momentum indicator. This is looking at the stock market, or in this case, the NASDAQ 100. That's what it was, ripping up into that was the October of 2009 high, the end of what I still refer to as the last real bull market, with the last real bear market we had, about a 55% drop. And you can see, in a healthy, coming off the bottom of after a bear market is over. This was the previous bear market ended here in 2002, and stocks started moving up. And as often the case, it's very healthy to see the number of issues. In other words, the NAAD, the advancing versus declining line, moving up in line with the stock market. That's a healthy advance, right? That's what we refer to as market breadth. Good internals. That's what you want to see. But then, and again, these divergences can take quite a while. And, they play out, and you start to get these little, that's divergent one. You go up, you have another correction, divergent two, and it's all one. You can see one larger divergence that culminated right here. This dotted line is when the market peaked. And so that foreshadowed that 55% drop. So it didn't come out of nowhere. It wasn't random. And that is the nature of this. And guys, what's happening there when you see that is exactly what's happened so far this year, and it's exactly what happened leading up to the top when the NASDAQ peaked in November of 2021, which is right here, and you can see it. And what that is fewer and fewer stocks, and it ain't the bottom tier of the NASDAQ 100 or the NASDAQ Composite. It is just a handful of stocks with the highest weighting that give the index a false guise of being strong, where all of a sudden the rest of the market, first it's 50 and then 60 and then 70% of stocks are moving down, going down, when only a handful are going up, again because they're the big beloved. It's for many factors and reasons: cash they have, stock buyback programs, and also the fact that they are the crowd favorites, so they continue to go up. The rest of the market goes down, and if you're not looking at lifting up the hood and looking underneath, then you miss those big turns. So these are ways, and you can see it again. Study this chart, screenshot it. That was you can see the red. These are the biggest corrections we've had. That was bear market was over here. You can see healthy advance in the NAD along with the NASDAQ 100 up top. Then we started diverging right here at this point. We had at that point the biggest correction in the start of the bull market, well into the double digits. We didn't have, then everything was healthy for a while. Well, actually right here, you can see we started to move on up. But then the divergence started here. So you can see my divergence lines. And then this, it was double digit. It was actually a bear market by the old definition, what I call old, 20% drop in things like the, I believe the NASDAQ composite. I know the small caps, a lot of indexes. And it was a sideways market. It was almost 2 years of sideways to down with two big corrections in there. And that came after that divergence. So you can say this. I often say stocks can correct in one of two ways, or a combination thereof, either in price where they go down, or in time where they go sideways. That's also a correction. Or again, when it's a little of both, that's what that is. Fast forward COVID. COVID, as I said many times over, was not a random event. It may be considered, and we'll go down in the record books, as a black swan event, but it was certainly priced into the technicals, and we were, short at the highs and down into, those lows there. And that was also foreshadowed there, as was this last thrust up. Again, clearly identified here. So, very, very few. I remember at the time clearly, because I was just as bearish if there's another big drop coming as I am now. Emphatic, laying out targets. And that was right in the beginning of the year right there. And again, that was, we'll go down and certainly considered a bear market by most metrics. To me, it's still just the initial leg down in a much bigger bear market. But, and again, I'm going to pull over a chart. This was on the site. This isn't kind of hindsight stuff that I'm looking in here. I don't do that. I don't ever play that game. If I ever post anything in hindsight that I didn't see before, point out, I will point that out as a, hey, I missed this, and here's something to watch and take away as a learning experience. This I posted here the very last day of 2021, October 31st, 2021. It's on the site, and I quote, "While I've seen divergence last longer, for example, leading up to the 2007 bull market top, I can't recall such a steep, pronounced divergence between the NAAD and the NASDAQ composite," which again I've been using up until today. I just replaced the composite with the NDX. I have both charts, and again, so that foreshadowed that. And we had, believe me, remember, we had sell signals in November. We were short right off the highs, and not just short. Everyone's short, and all swing traders short all the time, go long. This laying out targets that were hit, the targets that were hit when the market bottomed, and that's when we covered in a lot of shorts, and because they hit targets. I'll get to those in a second. Okay, so that was it right there. And that's what followed. And again, we didn't have divergence at the low, but okay, so that was then, this is now. And what I'm trying to do is just call it, sell you on this if that's what you want. I'm not, trying to tell you what to do. I don't take any of your profits on your trade, nor do I share in the losses. You make your trades, you decide what to do. My job is to provide analysis. As an extra, I throw in what I'm doing. I'm glad to share what I'm doing. I don't always take all the trades I post. I don't always... only for many reasons, not only limited to what positioning I might already have, or just, hey, here's a development, may or may not pan out. But in this case, we were able to milk almost all of that with near impunity and gain the counter trend rallies in there. And now so that was then, this is now. This is the NASDAQ 100, or the NAAD, again, the NASDAQ I'm sorry, this is the NDX right up here. I'm getting it backwards because on that other chart I had them flipped around. The NASDAQ 100's up top. This is 2023. You can see my year break. This is the year break line right here. There's the beginning of the year. That's that strong rally. Remember, we were 110% bullish and long, covering all shorts, posting that on January 4th and going long, with my favorites being, other than the overweight in QQQ, long Apple, Amazon. And that's the rally that we had in the NDX, and it's carried quite a bit. And you can see all year long, as I've talked about, and others, it is, you've seen this, well, this part you didn't see. We knew from a mathematical weighting and looking at market breadth, but this is showing you that market breadth, that the NAAD was severely lagging, i.e. negative divergence. And it's really fallen off a cliff lately. While you can see we had that little correction we called for, and we were short until just right recently at the lows. And you can see the NASDAQ 100 has kicked back to where it was, which now extends that divergence. So here we are, guys. So that's why I have this red so far. Here, zoom in. Let's zoom in. We have to scroll. Let me zoom so you can see. I'm going to have to move this over a little bit here. There it is. Sorry, I work off, my primary monitor's what is it, like 40 something inches, is made up of like multiple smaller segments, and I'm just trying to move things around on there, and I'm only screen capturing a tiny little bit. If I tried to capture that whole monitor, it would everything would be tiny. Anywho, that's it. So you can see right there, this is what the NASDAQ 100's done. It's had a correction, it's thrust back up, but yet we'll scroll all the way down. You can see severe divergence and underperformance in the NAAD. Okay, so the dotted lines mark the turns and the big corrections, the dashed lines. So only in hindsight will I be able to put one in here with confidence. And I can tell you this, that if we go up now, we might get a kickback. And I'll watch this. What you want to see, if you are bullish, like those folks that, or the comment on the Zweig breadth thrust yesterday and, things, you want to see participation in lower tier. And as I said earlier in the video, in reply to that comment, 1 day doesn't make a trend. 2 days doesn't make a trend, but 2 weeks, 3 weeks, 2 months, 3 months, that starts to make a trend. And then you start to say, hey, you know what? The market is healthy under the hood. Okay, and before we get off breath, this is just a quick thing here. So I had this comment yesterday. If we go on to make a marginal new high, it's so close to the all-time highs, it'll probably act like a magnet and push through the all-time highs to make another all-time high. I get it. I think that what he's saying there, he or she, is that the mid-January or late July highs, that's the most recent major reaction high in the NASDAQ 100. And then the high is all the way not too far above that, back from November of 2021. And yes, I could see that. And I'm going to get to that in this video. Towards the end of the video, I'm going to give you kind of try to zero in as best I can on if things play out the way I think, when they're going to play out and how they're going to play out, and levels to watch. So that's the takeaway. I'm not just going to sit here and talk for 40 minutes about the market can go up or the market can go down. I might be wrong, and you don't want to be sitting short for the next year if the market's going to go up another 40%. You'd get wiped out. Okay, so my reply to that. Should we get a marginal new high in the broad market soon, it would still reek of the very narrow leadership and lifting from mainly the Mag 7 that the market has had for nearly all of 2023 so far. Okay, so I just showed you that. Again, it's cited in many articles. It's the mathematical weighting they've done. They've contributed to the vast majority of the returns, particularly in the NASDAQ 100. So I went on to say there are 11 sectors in the S&P 500, which of course is a much more balanced, diversified, more representative of the U.S. economy than the tech-heavy NASDAQ. So there's 11 sectors in the S&P 500, with tech or technology by far being the largest at about a 25% weighting. And it is the only one currently threatening new highs, okay, that sector. The bottom 3 or 4 sectors in the S&P 500, they don't move the needle due to their very low weightings. And those are real estate, basic materials, and utilities. They have like a 2 to 3% weighting. It just doesn't even matter what they do. They can double or triple in a year. It doesn't even offset, a much smaller gain in the tech sector. So let's just not talk about those. Not that you can't make money trading those stocks, but again, I'm talking about the significance of the market. So, with that being said, the second, third, fourth, and fifth largest sectors in that order are still well below their previous all-time highs. Healthcare, second largest sector in the S&P, is still, and I did this as of yesterday, still 11% below the previous highs. Financials, 20% below. Consumer discretionary, 28%. Industrials, 6%. Communication sector, 23%. Okay, guys. So, I guess it's semantics. If the NASDAQ 100 were to make a new high, yes, would they cheer? Would they say technically it can't be still in a bear market because it's exceeded the previous bull market high? Sure. But again, semantics. The stock market will not, you can say what you want to say, but until the stock market, meaning the S&P 500, the mid-cap 400, the Russell 2000, or you look at a broad-based of Wilshire 5000, which has small, mid, large caps, that index that VTI tracks, the Vanguard ETF that tracks that, it's a well-diversified small, mid, large cap, all domestic stocks. When they take it out, then yes, absolutely. You can say with definitively that the October 2022 lows mark the end of a bear market and the beginning of a new bull market. Okay, all right, and again, this shows you that what I'm trying to show you here is it's all tech, and of tech, it's all the big tech. So most other sectors are well down, and believe me, there's consumer discretionary and communications. They have a good weighting in some of those big fangs as well, and they're still way down. Okay, so that ends my in-depth discussion on market breadth. As I said, all the sectors, every one of them, even those bottom tier ones that don't move the needle, all well below previous bull market highs. So by every metric that I use, just about the case can be made that we're still in a bear market. It's a bear market rally. There are other metrics that say maybe not. We've exceeded some fibs, and if you look at the big market leaders, but again, the majority of the evidence points to that for me. And again, time will tell if that's not the case. We'll hopefully adjust, or I will ahead of time. And as I always said, I give you support levels, resistance levels. Made a case for the big rally that we had in the equity markets. Unfortunately, personally, I didn't catch all of it. Caught the first part of it, and hopefully some of you did. So that's the takeaway. I provide that analysis. You guys decide how you want to trade it. All right. This was a quick question. I was just going through the post here. Does anyone know of a home builder inverse ETF? Because I put the builders up back on as a new short yesterday. And yes, I'm sorry, I don't think one exists. NAIL, N-A-I-L, is a 3-time bullish one. They used to have an inverse to that, Claw, the same ETF company, but they like many short ETFs, they got rid of it. It didn't, when you're coming off the biggest secular bull market in the history of the world, short ETFs are starting to become extinct, and that's also, I think, a sign that the top is probably very near. We'll probably see a lot of these 3-time leveraged bullish ETFs disappear in the next over the next 5 to 10 years, in my opinion. All right, that was just a kind of a FYI thing. And again, if somebody knows of one, please chime in. I think that was that post right there. I want to get to this last one, and then we'll move on. Okay. I'm glad Be Right asked me this. Okay, how do you see NVIDIA going into earnings? Okay, you guys probably heard me say, if you followed me for a while, that to try to guess where a stock is going to go after earnings, and let me be clear, I'm not talking about the initial pop, right, when the earnings are reported. NVIDIA is scheduled to report next Tuesday at around 4:20 p.m. after the market closes. What I'm talking is the lasting direction. Again, not any initial knee-jerk reaction. You have the initial knee-jerk reaction when the numbers are released. The humans plus the algos parse through that data as fast as they can. There's going to be some volatility. The important thing, then comes a conference call, and then comes the big boys step onto the field the next day. I'm talking institutions, because they don't have there it's not very easy for them to maneuver in after hours trading. You don't have as a liquid market, and market orders and all that stuff don't exist. You gotta, so they're usually going to, if they decide to get out, plus their folks are going to work on, study the numbers all night, their analysts, and decide, oh, we need to add to or get rid of, cut our position. So my point is, wait for the dust to settle. Sometimes you'll know right away, and sometimes it takes a few days. So I'm referring to the direction the stock is going to head from there. Another way for me to spin it, let's say the next double digits. Is it going to go up or down? What's the next double digit trend? Okay, so I always say if I don't have an opinion on where a stock is headed due to the charts, then it's a crapshoot. It's going to go either way, and I don't bet it. When I do have an opinion, because there's a clearly bullish or bearish chart, then it has been my experience that much more often than not, the stock is going to go in that direction. So we're going to get into NVDA now. I'm going to talk a little bit more on NVDA than I might on another stock, because I think it is, at this point in time, I know it is, in my opinion, the most important stock that's going to have an impact on where the market goes from here. And today is Wednesday, right? We only have till this time next week, we should have a good idea. So whether or not the stock gets an initial pop or drop immediately following the earnings report after the market closes next Tuesday, an equal or marginal new high before or shortly after that earnings report, again, November 21st, will only extend the large divergences that were in place at the previous high, and very, very likely come around the start of the next bear market and journey down to my next long-term target from early 2022. Okay, so I'll get to that in a second. So here's my current weekly chart of, it's in that post. Yep, weekly chart. This to me is clearly bearish. We have divergences. That, forget about this line right here. Let that, I don't know. This is the divergence line right here. That one, we had divergence and I never removed that line. This is our current divergence right here. It started at this point right here. And you can see we're roughly at the previous highs. So technically speaking, the way negative divergence works, as long as prices are making an equal or higher high and the indicators are making lower highs, which they clearly are, that's negative divergence. So I can easily see, in almost coin toss, if I had to bet it, and I'm not going to bet it, but if I had to bet it, probably see a little pop, post-earnings pop, to give us nice clean divergence, a higher high, suck in some more longs into that NVIDIA trade, blow out if any shorts are in there still. And you can see here, you'll just have nice clean divergence on the MACD with clean separation. And so no difference from the negative divergence you had here. You can see from that point to that point, negative divergence. You had divergence here, building all up to this point. That was followed by a 56% drop. And this one, let me go to the current chart. Let me do that. This is the screenshot I posted today. NVDA. There's our daily. You can see where, you can look, I put a horizontal line where this is my, I'm sorry, that's a trend line. I'm not crazy, but this is the previous high right here. And so we're roughly, right now, we technically have that divergence. We have an equal high, so it's made. And any new high anytime soon, see these indicators, the stock would have to go up 40%, 30, 40%, something insane to negate the divergence. What I mean by negating the divergence, well, by you have to take out the previous highs right here, because this is our current divergence line. And again, it shows through on the weekly. That's the daily. When I see big divergence like that, it conveys over into the weekly chart, and that's the kind of divergence. There was that line that kind of disappeared there. And remember yesterday I talked about the extreme readings, and that works on different time frames. I was on the daily, but this 87 level on the weekly RSI, the weekly chart of NVIDIA, seems to be the magic number. What I mean by the magic number, it's about as overbought as ever gets. But again, shorting overbought, you can get killed in a bull market. Overbought tends to either stay overbought or become more overbought. So what you want to see ideally, once you hit that level, you want to start seeing divergence form, meaning the RSI keeps thrusting back up. as prices are going up, but the RSI is going making lower lows. The RSI, like the PPO, is a momentum indicator. So that shows us this trend, as strong as it is losing momentum. And eventually, boom, 56% drop. Right here, off that high, we had a 70%, almost 68, 70% drop. Now, who could have called that? Again, going back to this, because I don't like hindsight analysis. This was, I first covered it in the video before we even broke down, but then I put it out as an official trade I did with the chart here, and you can reference that, posted February 3rd, calling this stock down, saying the video offers an objective short entry here on the backtest of the recently broken up trend line following the most recent divergent high on this weekly time frame. Arrow breaks denote the likely reaction points, although the arrows do not align with the expected time frame of the targets being hit. So every arrow break is a target, price target. I think you can see them on the screen here with reactions. And my second target was 116.34. And that was the target that was hit. And if you recall, I posted it then, covering shorts, going long, had many stocks, not just NVDA. So again, very few, and you can see a perfect technical analysis. This is just technical analysis at its finest. There's a divergent high, a breakdown, as I often say. Sometimes you drop. That was a support level. We hit it, bounced, made a perfect back test, then went down, hit my first target perfectly and bounced, and that was double digit. That was probably 20-something%. Again, remember this whole move was, what was it? I say 60, 70. And then we went down, started working down, hit T2, and we bounced. And again, there was strong divergence on a lot of things when that was hit right there. And so that gave us this rally. And here we are. We've now come full circle. I'm going to correct this divergence line to what it should be. Starting to diverge at this point here. And again, right now we have that roughly equal high. So what I'm doing, I told you I'd try to sharpen my pencil and give you some timing here. To me, this stock, and if there's going to be a catalyst, it's probably going to be earnings, right? And again, maybe not the day of, but within the week or so. A blow-off top would be great if we get it. What's a blow-off top? I pointed one out in Microsoft, before the big drop. This is a blow-off top. When you're going up and all of a sudden you start to go vertical and there's a big surge in volume, that's called a buying climax. You don't always get them, but if we got one, great. And so I might look to short a buying climax. But we don't have to have it because we already have the divergence. The top could be in. They could start selling this thing down before earnings. I don't know. I just know the upside, in my opinion, is limited. And there's a primary key uptrend line, off the lows. We don't have a lot of reactions, but what we do have are the beautiful, I love these 40-week moving averages, aka 200-day moving averages on the weekly chart. It's a 40 period, simple and exponential. I use them both. They do a phenomenal job of defining bull trends when price is above, and when you take them out, as you took them both out one fell swoop, or NVIDIA did there, it starts a bear trend, 50% bear market, rally back when you're in a bear market. These moving averages then act as resistance when below. So you rally back up, short. So if you came that bounce long, you were able to exit your longs there and reshort. And then when you saw the 200s regained right here, you're in a new bull market. And guess what? If you missed that signal to get back in, you had another buying up when they pulled right back to the 200-day moving averages there, or 40-week. And you had it again here, another pullback. So, this is it, guys. This is technical analysis. It's a combination of, the horizontal price support levels and resistance levels, trend lines, and key moving averages, Fibonacci retracement levels, all that good stuff. Took them out right there. Bear market. Again, that was at 70 or whatever, 60-something% drop that I called for back here. Perfect tag at T2. Again, you wouldn't have stayed short for many reasons back then. The bounce certainly carried farther than I would have thought. But again, even as a trend trader, and I made it clear in those targets, it could take months or years. I expect it to take years. I didn't think you make a call like that from that point NVIDIA would drop, 90%. Are you kidding me? So I think ultimately it has a potential. Right now, I'm just eyeing T3. If we get to T3, which is the next target, because T2 has already been hit, but you're not going to go straight down to T3, but I think it could be a pretty quick ride if the market's going to have the next leg down as powerful as I suspect it will, I'll be a lot less interested in trying to game the bounces off those. And these again are the old support and resistance levels. They'll still come into play. In fact, T2, I had identified that 116 level before we even hit it there. The fact we hit it and bounce and had that's a major reaction low, completely helps to validate that. It was a level that I was eyeing before. And so now that's a very big level. So yes, we get there again, depending on how the charts probably bounce, could be a big bounce, could be the end of the bounce if we get there. But it's already been tested once. We could go through it. And again, I'm getting way ahead of myself, but to just try to put it in perspective, and this is where I frame all my trades as a RR risk reward ratio. That's 85% drop. And I'm not telling anyone what to do, and I'm not a big fan of options. I've been a long time, learned my lesson. I prefer trading shares directly and or stock futures. But the amount of money, because the markets, nobody sees that. Nobody saw that. If that happens, 85% drop, I mean, just even shorting it, would be a huge profit, money that most people don't make in a decade in their account. And again, you don't put too much in any one trade. It's not the index, it's an individual stock, and maybe it keeps going. I know I'm talking a lot about it, but I'm talking a lot about it because this is the last of the Magnificent Seven. This stock, relatively abruptly, because of its phenomenal returns and growth, has joined an elite group of stocks now referred to as Mag 7. And the thing about that is that all of them, they are the old fangs. Apple, Microsoft, Amazon, Facebook, Meta, Alphabet, formerly known as Google. Those are the rest of them. And they all report earnings in a 2-week cluster, all around each other, right? And that's probably for a reason back then. They were all, kind of in that big boy club, and that was scheduled. So NVDA is kind of the outlier, and that's why I'm talking so much, and I'm so glad somebody brought that up. Here's the report right here. I have the lines there. There was the last report. And you can see the stock rally. There's a great example of what I talk about, guys. The post earnings pop. It would have reported that's the earnings date right there. So after the close, so rally the next day on what was probably phenomenal earnings. But guess what? That was where most people would say, "Oh, you're crazy shorting the stock." But the stock from there fell 22%. That literally was the day after earnings marked the high, and then it never went any higher. And so I just, again, wanted to point that out. So it's, not the initial reaction. Sometimes it takes a day or two for the market or a stock to pick its next direction. And it can go the other way, guys. But I would put very, very good money that it's not going to, that it's going to go this way, whether it does this or this. Okay, enough on that. And again, you can reference all those charts on there, and like I say, do what you want to do. And then finally on this, one last thing I want to bring up. I know I'm talking a lot about NVIDIA. NVIDIA, this is where, my worst run on index shorts was at this point in the middle of this year. It was very bullish and long, all those guys on that initial leg up off the bottom, covering all shorts. And I'm talking about the stock market in the beginning of the year. That's when most of the big fangs, Apple, Microsoft, those guys bottom, Amazon. But something happened right here, and this was where the AI bubble came really full circle. NVIDIA had just a blowout quarter, and I remember it clearly. I believe I was traveling at the time. I think it was in Hawaii, but it had the bull parade was marched out, and they were just salivating all over themselves. Every analyst, pundit saying that this AI thing is phenomenal, it's going to change the world. And it was a big thing. And believe me, NVIDIA is making a ton of money off it. Don't get me wrong on the fundamentals, but how much of that's been priced in? That was a massive gap. I mean, from the previous day's close, I'm on a daily chart here, and I grabbed the bottom of that where we closed that day to where we, closed the next day, 27%. And it had a huge impact on the NASDAQ 100, something I've talked about quite a bit, and the reason I have key levels here. That was right here. And it was if you can see here, a thin zone right there. Let me roll it up. See my volume price histogram? I'm going to box it in for you right here. This is what we call a thin zone, where there's very few trades. That was 100 100% due to the NVDA gap. Because the big fangs had all reported before that. They always report, remember, a few weeks before. And so there was no fundamental change in the outlook for Microsoft, Amazon, or no reporting or anything. So this was all NVIDIA. Okay. And so everything in the subsequent consolidation since then. So really the stock market, the NASDAQ especially, has gone nowhere since it made that, followed up that NVIDIA gap, the euphoria, the AI hype. It kind of just set the market here and right now into this trading range, and it's been testing the bottom of that. And that's one reason I have those purple levels. If we go down much below there, that's going to be catastrophic. It'll wipe out. You can see these volume at price histogram bars here. Over the last year, especially the second half of the year, there's tons of supply, meaning buyers here that will go underwater if we go down. And it all the same. My theory here is the same stock that took us up there and put us in this range is the same one that has the potential, and in my opinion, will take us down. So again, I made the case. I started out making the case from a technical perspective, and you have levels to watch. Let me turn lines back on. This near-term uptrend line is not too strong, really. I would just, like I said, the divergences are there. They're not a sell signal. There are no sell signals right now in NVIDIA. You could take a shot at, a rally into resistance. That's always an objective reason to short. But again, they're going to report on the 21st. You can get run over, even if you're right, even if I'm right on where it's going here, and you go short before it, you may have to ride out a big stop clearing pop and drop, just like the last time they reported right here. Okay, and to take this video home, it's getting a little bit long here. I told you, kind of indicated it would be a long one. We have so far, we have CPI out of the way. Remember, CPI came in one tick cooler on each one. 0.1%. Well, that's not tick in the in the bond market's 1/100%. But 0.1% or one notch down. They round out to the nearest single decimal there. So we were just slightly cooler on the CPI. Yet the the fundamentals were there in the bond market. So the bond market continued to rally. Overdone. Given a lot of that back today, yields are pulling back. As I told you yesterday, I expected that was it. Yesterday's pop was it, and so far stocks opened up. Yields have been moving up all day. Meaning bond prices down since they peaked yesterday, and so far the stock market's starting to get the memo. We're about to go flat on the NASDAQ, but we haven't yet. Either way, CPI is out of the way again. Now, we all know what happened yesterday. Retail sales today, and here's the headline. I won't read the whole article, nor do I think I can. It'd probably be a violation of my subscription to the journal, but retail spending cooled in October. Retail spending fell last month for the first time since March. Americans are pulling back just as the holiday season comes around. Again, what my original background was fundamental analysis. A lot of what I do is technical analysis, but I do very much incorporate fundamentals. Problem is, the fundamentals quite often take time to play out. They do ultimately determine where the market or the economy goes, or as individual stock, but technical analysis is a much more accurate predictor in the short term and when to get in and out of those positions. But I just wanted to point that out because I told you we had a heavy economic calendar this week. I'm watching. So that was that. So bulls like that. I cannot tell you how many folks I've heard come on TV and things in writing as well in the financial media that have declared. It reminds me of George Bush's famous battle. What was it? Mission successful or mission accomplished. That's what it was. With what was that? Afghanistan, Iraq. Anyway, that we all know what happened there. So everyone's declaring that the Fed is absolutely done. That is the nail in the coffin yesterday. That there will be no more. Look, I don't think there's going to be any more hikes. I do agree the next one will probably be a cut. However, where I differ from everyone, they think that rates are just going to continue to fall. And the stock market's going to go up. I think rates are going to work their way down. Ultimately, more of a flight to safety, and nobody wants to buy bonds thing. What am I talking about? Nobody wants to buy bonds. If somehow you've been living in a bubble or you don't follow this stuff on a day-to-day basis, I implore you to take a look and read up on what's going on with the U.S. Our debt, our spiraling debt. We have the biggest non-wartime debt to GDP ratio ever in the U.S. We continue to spend, spiraling debt, and we're coming off years, decades, actually 4 decades of falling rates and really almost, what was it, 15 years of near zero rates. And so it's not just the federal government, it's municipalities, corporations, everybody's engorged and bloated on that debt. And make no mistake about it, that debt was the reason for the supersized bull market that we've been in over that period of time. However, this comes from the Journal today, and there's just a lot of growing evidence here. These are factual numbers. These aren't opinions. These are estimates. I will say these are estimates, but they're pretty, estimates based on real numbers. It's easy to see. A lot of this debt's public, and what they're looking at is these are world government's annual net interest payments on their debt. So, it's almost a Ponzi scheme. Ponzi schemes, just like Bernie Madoff had, they work great. They can go on for years, even decades, as his did. But at some point, and a Ponzi schemes can end. The U.S.'s Ponzi scheme is, to continue to issue more debt, stimulate. It's not a problem until it is a problem. And then when it becomes a problem, there is a flashpoint. We don't know where that is. We haven't hit it yet. We've started to see some rumbles, I think some tremors, in the bond market. U.S. just got downgraded. The market shrugged that off completely. That was just the other day. But this is going parabolic. And it's going to get to the point where nobody is going to want to buy our bonds and a lot of others, and that includes municipalities and other countries. But and that's by the way, guys, if I didn't clarify, this is the world government's annual net interest payments on their debt. That's not the debt load; that's the interest payments. So you get to a point where your debt's so high, it's just like, think of your neighbor, or unfortunately, if this ever happened to you or anybody personally or family that got buried in a credit card debt, something happened. It's the same thing. There comes a point where that debt, it's unsurmountable. You cannot get out of it, barring, a lottery win or something, because the interest to service a debt gets to the point where it vastly exceeds your income. And so that's where we're heading. And again, these are, I won't say immutable projections, because we could see if interest rates really spiral down. But what you have to think, how are rates going to get back to where they were, near zero rates again? The only thing that's going to happen or allow for that is another economic disaster, financial disaster in the financial markets, a big problem that would prompt the central banks to go that low again. So that's fundamental stuff, guys. And then I'll leave it at this on the fundamentals. The other things I'm looking at, again, jobless claims. You get that weekly. I don't know if it has the potential to roll the markets. We also have industrial production tomorrow at 9:15. Remember, that's one of those quirky reports that comes out after the market opens. Most of them are 8:30 a.m. Housing starts and permits on Friday. But I continue to keep close tabs on the employment, the jobs market. And this is what we're going to get tomorrow, initial jobless claims. And also watch the continuing claims as well. But you can see, as I talked about, I gave you a chart last week, we're ticking up. We still have a series of higher lows here. Remember, this was post-COVID. Everything was returning to normal after COVID. So far, it peaked here, and there is an uptrend so far, early in the making, but really where the magic number comes in, as I said last week, if and when we take out. So if we have a surprise, I think the consensus range is up to like maybe 225. It's in there somewhere close to where we were last week. And I think the upper end of the range is, you can go here and find it, and you just go there, click on jobless claims. The range is 225. Consensus is 222. And so these are things I watch. And again, it's just something I watch. I'm not making a prediction, but I will make a prediction that if you come out hot, remember 225 is down here in the middle between 200 and 250. So this is the top of the consensus range right in the middle. So anything much above there, especially if it were to pop above 250, ooh, hold on to your shorts, because that would help. I would think most would see we have a clear trend that the job market is now rolling over. Another one to watch, of course, is the unemployment rate. This is a big one too. You don't have to be a skilled technician to see this looks like a stair stepping. You're going to fluctuate, but here's the jobless claims. We're stepping higher, and recently we had at least a stair step up, notch down, but then we'd notch higher and higher lows. See, again, this is just a bar chart. You can put it on a line chart if you want, but you can see the trend here. I'll do that chart, go line chart if you want. Let's see, why is that not loading? There it is. Okay, there's your trend. Okay, again, it doesn't take an expert technician to see you've got an uptrend here. And that's the one thing that I and others have said. And look, if this trend continues and the economy doesn't roll over, and I've also heard multiple people just in the last couple of days with the Treasury bond yields coming down recently, that also saying that the Fed has pulled off that magic, the 1 in a million soft landing or no landing scenario where we're not going to have a recession now. So recession odds have gone down considerably. But here I'm looking at the one and the most important thing of all the economic reports. Nothing matters more than the consumer. The consumer loses their job, consumer spending goes. Consumer spending accounts for 2/3 of GDP, which is gross domestic product. It's pretty much the earnings of the United States, if you want to call it, all goods and services sold. So, and being that about 70% of that comes from the consumer spending, there's never been a point in history where you saw unemployment surge and the consumer kept spending. They've been resilient lately, but we're just coming off the bottom. So if this continues to tick up, we don't have a recession and a hard drop in the stock market, then I wasted a lot of money on my business degree, because everything you learn in economics 101 tells you that this is, you're not going to have rising, especially a considerable shift. And I'm talking a trend shift. I'm trying to identify not just a tick up that goes back down, but an ongoing trend. And when you look at the long-term charts of unemployment, the thing is, once the bottom is in, the turn comes and then it begins to accelerate. Okay, and that's when the recession comes. This chart's not going to show me. I have other ones that'll show you all these rises coincide with recessions. And so that's what we're looking at. Okay, very long video, one of the longest I put here in a while, but again, I kind of gave you a time frame on when and if I'm right, when things are going to turn. We're at that point that I was saying in that map in my head a few months back, and a couple, even up to a few weeks ago, that if it's a bear market rally, the time, one of the signatures you'll see is just when the masses are convinced, like some of the comments I got yesterday, that we are not in a bear market anymore, that it's a new bull market. It just looks so good and so ripe to everybody, the rally and the technicals and everything else. That's usually when they do the rug pull. So we make it through NVDA, and NVDA continues to rally and takes out new highs and continues for the next 3 to 6 months. Market's probably going higher, and even the major indexes, the diversified ones, might even see new highs. So I'll reassess, my outlook in the wake of NVIDIA. Like I said, I'll give it at least a couple days, and then we'll go from there. All right, guys, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.